Welcome to vTalkInsight, Allocator's Lens Daily for January 26, 2026. We start the week with accelerating growth, stretched equity valuations, and rising cross-asset correlations all competing for attention. Tech earnings, a pivotal Federal Reserve meeting, and sharp moves in gold, the dollar, and natural gas are converging. So portfolio risks are shifting more through rotations beneath the surface than through big index swings. Let us begin with equities, where leadership and valuation tensions are front and center. In equities, the macro backdrop still looks remarkably supportive, with forecasts for U.S. growth above 5% in the first quarter and productivity running close to 5% on recent readings. That combination underpins expectations for low double-digit earnings growth in the next year and helps explain why the market has stayed close to all-time highs, even after bouts of volatility. At the same time, U.S. valuations are undeniably rich. The S&P 500 is trading around 22 times earnings. Profit margins are at record levels, and the current bull market has already lasted roughly twice as long as the historical median. That leaves limited room for disappointment and raises the risk that any shock, whether from policy or earnings, shows up as multiple compression rather than a simple pause. Beneath the headline indices, however, leadership is clearly rotating. Recent months have seen value, cyclicals, energy, materials, industrials, regional banks, and even emerging market equities outperform mega-cap technology, while transports and building materials have joined the advance. Small caps have outpaced the S&P 500 by several percentage points year to date, helped by expectations for easier short-term rates, better manufacturing surveys, and rising merger activity, even though roughly 40% of that index is still unprofitable. At the same time, quality stocks outside technology and defense have lagged by the most in 2 decades, and markets are rewarding sectors tied to onshoring, infrastructure, and the AI infrastructure build, from industrials to specific building materials names. Internationally, emerging markets in Japan stand out on valuation grounds, with forward price to earnings ratios well below the U.S. and improving breadth in their tech and commodity-linked segments. The near-term risk for equities is that this constructive rotation collides with a very concentrated earnings and policy calendar. Over the coming days, a long list of mega-cap names in technology, payments, autos, and consumer sectors will report alongside the Federal Reserve decision. Index-level earnings for the S&P 500 remain heavily dependent on an expected 30% contribution from technology, yet that sector is already valued above 30 times earnings and has been underperforming recently. Options markets are signaling large implied moves for some platforms, and commentary suggests that even strong results at leaders like Microsoft or Apple could be met with selling as investors use good news as liquidity. With volatility measures still hovering in the mid-teens after a sharp sell-off and rebound earlier in the week, allocators are watching whether this earnings cluster triggers a deeper first-quarter correction or simply extends the handoff from mega-cap growth towards small caps, cyclicals, and select international markets. That brings us naturally to rates, because the durability of this equity rotation depends heavily on how far yields can actually fall. Rates markets are trying to reconcile very strong U.S. growth with still slow-moving disinflation. On one side, the narrative of a productivity-driven boom, supported by heavy AI and infrastructure investment, points to faster trend growth and room for the Federal Reserve to ease without reigniting inflation. On the other, more traditional models warn that current monetary policy is actually more accommodative than the Fed believes, especially when adjusted for inflation, and that sticky prices could eventually force real rates higher, not lower. Against that backdrop, market pricing has converged on only about 40 basis points of cuts this year, essentially one move with debate around a second, and little expectation of any change at the upcoming meeting. Longer-dated U.S. yields remain anchored in a relatively tight band around 4 to 4.5%. Higher structural deficits, post-pandemic fiscal expansion, and concerns about term premia are capping how far yields can fall, even as the Fed shifts its focus from inflation back toward the labor market. Recent swings in global bonds have been driven more by Japanese moves than by the U.S. itself, as the Bank of Japan edges away from ultra-easy policy and Japanese government bond yields rise from historic lows. That Japan-led repricing has reinforced the idea that long-dated developed market sovereigns are no longer the straightforward hedge they once were, and that yield volatility can arrive from overseas policy shifts as much as from Washington. In this environment, many portfolio managers are favoring shorter maturity credit over long-duration government bonds, reflecting both the expectation that the 10-year yield stays range-bound and the perception that long bonds are more of a trading instrument than a strategic anchor. Surveys show that bond market volatility is subdued and yields are relatively stable despite political noise around Fed leadership, suggesting a cautious but not panic market. At the same time, inflation expectations in consumer surveys have eased to multi-month lows, which supports the case for policy patience rather than an abrupt hiking cycle. The key risk to this relatively benign rates backdrop would be a renewed inflation surprise, whether from energy, fiscal policy, or wages, that forces markets to price out those modest cuts and challenges equity valuations. From there, the discussion naturally shifts to credit, where spreads and issuance tell a somewhat different story about risk appetite. Credit markets remain strikingly resilient. Despite record or near-record issuance in high-grade corporate bonds, spreads have tightened, pointing to strong demand for income and a willingness to lend to solid balance sheets. Flows into U.S. fixed income remain robust, with investors still comfortable holding treasuries and investment-grade paper, even as they diversify marginally toward Europe and Asia. Emerging markets add another layer of support. Growth there is outpacing developed economies by roughly 2.5 percentage points, helped by earlier rate hikes and more disciplined fiscal policy, which keeps sovereign and corporate risk in those regions on the radar for yield-hungry allocators. Beneath that calm surface, several fault lines are emerging around consumer credit and banking regulation. U.S. credit card balances have climbed from around $800 billion in 2022 to more than $1.2 trillion. Reflecting robust spending, but also growing leverage. Proposals to cap credit card interest rates near 10% would, if implemented broadly, render much of the sector unprofitable and could sharply restrict access to unsecured credit for many households. Financial stocks are already underperforming, pressured by high-profile lawsuits against major banks and rising political risk, even as regional banks benefit from a steeper yield curve. Merger activity, and improving credit conditions signaled by their own share price breakouts. In private markets, enthusiasm for private credit and private equity remains high, but is maturing. Allocations that have been trending up toward the mid-teens as a share of portfolios now look more likely to plateau, as investors weigh attractive yields against the realities of tax complexity and liquidity constraints. Looking ahead, the combination of AI-related capital expenditure, onshoring, and energy transition projects suggests that corporate borrowing needs will remain elevated, but the cost of capital will be much more issuer-specific. That points to greater dispersion between high-quality credits that can fund growth on reasonable terms and more stressed borrowers exposed to regulation, legal risk, or structurally challenged business models. FX markets are already expressing some of these macro and policy tensions, particularly through the dollar and the yen. Foreign exchange markets are increasingly where investors are choosing to express macro and political views. The U.S. dollar has just logged its weakest week in several months, even as U.S. growth and corporate margins remain strong. That softness reflects a mix of rising term premia in U.S. bonds, diversification of reserves toward gold and other hard assets, and growing allocations to Europe, Asia, and emerging markets where valuations look more attractive. Emerging market currencies have rallied alongside their equity markets, underscoring a shift in preference toward higher-yielding or higher-growth regions rather than a simple flight to safety. The Japanese yen sits at the center of the current FX narrative. Recent Bank of Japan decisions and more hawkish communication have triggered sharp swings in the currency, with some moves so abrupt that traders are openly debating whether stealth intervention has already occurred. Officials have not confirmed any direct action, but the backdrop is clear. Years of yen-funded carry trades have left positioning stretched, and the currency is now very sensitive to any shift in global risk sentiment or policy surprises in Tokyo. Current conditions of broad dollar weakness and heavy speculative positioning mean that if Japanese authorities do step in decisively, there is scope for a substantial and lasting yen appreciation as stop losses cascade. More broadly, currency markets have become a primary channel for hedging U.S. political risk. Instead of dramatically reducing exposure to U.S. equities, which continue to benefit from productivity and AI-driven earnings power, many large investors are adjusting dollar exposure, leaning into other majors or gold as complementary hedges. That helps explain why U.S. bond yields can remain relatively stable while the dollar weakens and gold rallies, and why volatility in FX pairs such as dollar-yen is running hotter than in other asset classes. These shifts in the currency complex feed directly into commodities, where gold and energy are sending powerful, if sometimes conflicting, signals. Commodities are where both risk aversion and structural change are most visible right now. Gold and silver prices have surged to record levels, with gold trading near $5,000 an ounce and silver also at extremes. Central banks and major investors are increasing allocations to precious metals as part of a broader diversification away from U.S. Treasuries and the dollar, while exchange-traded products make it easier for retail capital to access the trade. Geopolitical tensions, concerns about the long-term fiscal path in the U.S., and the perception that long-dated sovereign bonds are less reliable hedges have all reinforced gold's appeal as a portfolio diversifier. At the same time, there are growing signs that parts of the gold trade have become overextended. Recent moves have been described as parabolic, and some scenarios now contemplate the possibility of a 30 to 50% correction over the coming months before any longer-term uptrend resumes. Flows within the precious metals complex also tell a story. Allocations to silver in at least one major product have risen sharply over recent years, and some managers are now rotating back toward pure gold exposure to lock in that relative outperformance. Option-based overlays, such as call selling on gold-related equities, are being used by some to harvest volatility while retaining core exposures, underscoring the tension between strategic demand and near-term froth. Energy markets are sending a different but equally important signal. Short-dated U.S. natural gas prices have jumped more than 70% in a matter of days, driven by severe winter weather, freeze-offs that temporarily disrupt more than 10% of production, and surging heating demand. Speculative positioning have been very light going into the cold snap, which amplified the move as traders raced to cover shorts, and regional prices spiked on concerns about storage and transport. Most commentary sees this spike as largely weather-driven and temporary, but the longer-term picture still points to higher average gas prices than in the past decade, as liquefied natural gas exports grow and data centers and electrification strain power grids. Together with stockpiling of critical metals and the outperformance of energy and basic materials equities, that reinforces the idea that real assets remain central to hedging inflation, geopolitical risk, and the demands of the AI and energy transitions. Pulling the pieces together, the cross-asset picture today is one of strong real and nominal growth, modestly easier inflation, and a late-cycle market structure where valuations and policy uncertainty sit in tension with powerful structural themes like AI and the energy transition. Equities are rotating away from an aging, mega-cap-dominated bull market towards smaller caps, cyclicals, and international names, but the next wave of earnings, especially from big technology, will decide whether that rotation continues or a broader correction emerges. In rates, a narrow band for long-term yields and only limited cuts priced in support risk assets for now. Yet deficits, potential inflation surprises, and Japanese policy shifts keep term premia and bond volatility on the radar. Credit remains tight and well bid, even as consumer leverage, regulatory proposals around credit cards, and legal risks in the banking sector hint at greater dispersion ahead, while FX markets and gold have become key pressure valves for political and macro hedging. For allocators, the focus over the coming weeks is likely to stay on how this mix of dollar weakness, gold euphoria, natural gas volatility, and productivity-driven growth feeds back into earnings expectations, policy paths, and cross-asset correlations. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.